Welcome back to the Stuff About Money podcast. I am Erik Garcia, certified financial planner, joined as always by my co-host. Actually, not as always, because Xavier, you've been MIA a few times here in the past few recordings. But Xavier J. Angel, certified financial planner. What's happening?
Erik, not much. I'm doing great today. I'm excited about today's podcast.
Oh, it's gonna be a good one. So, over the past few years, I've had several clients come to me and say, "Hey, could you teach my kids about money? Please teach my kids about money." It's just kind of one of those things where it's like, yeah, of course, but we never really had that opportunity to do that. But this summer, we're working on a project. It's myself, you, Xavier, and then my son. We are trying to answer frequently asked questions from high schoolers about money. So our project for the end of the summer is to be able to produce not a curriculum per se, but some education around money and finance, personal finance for high school kids. And we just had a meeting this morning. That's why it's on my mind.
It was great. So for our listeners and our viewers out there, any questions that your children ask you, send it out there. Send it to us. Email us. Put it in the comments.
Yep.
Let us know, because we would love to be able to answer those questions as well.
Yeah, so if you visit stuffaboutmoney.com, there's actually a place down there where you could send us questions. We'd love for your feedback, and we'd love for one of your questions to make that list. Look, if you like what you hear on our show, we ask you, please share this on social media. Follow us wherever you get your podcasts, so that we can just continue getting the word out to help people have healthy mindset about money and learn about money and how to healthily use money in their life. So, keeping
with that theme, we get frequently asked questions from our clients as well.
Yep.
And so today we wanted to address a couple of those questions that we're getting all the time now.
They seem to be more prevalent right now.
Right. So I was recently, this past weekend, I was at a wedding. And at the wedding, everyone found out that I was a certified financial planner. And I had several conversations as we're having dinner.
Were they like, "Oh, I hear that you're a certified financial planner"? Or they like, "Oh, dude, you're a financial advisor"? Like how did that happen?
It was, so I had a client that was there at the wedding with us. Great friend of mine. We're having these conversations, and as we're introducing ourselves to each other, I guess money came up, and this individual said, "You know what? You need to go talk to Xavier. He's a guy that I work with. He's doing a great job." And from that, they started coming up and asking me questions.
Okay, so you weren't like handing your business card out.
No, I wasn't handing my business card out. we were passing phone numbers.
All right. So what's the question? What's hit us, man? Hit us.
All right. So the main question that I was getting there was, should I go into cash right now? There's talk of a recession. The markets are down. What should I do? Should I sell my positions and go into cash?
Oh, man. What'd you tell him?
It's a great question.
What'd you tell him? Should I go to cash, Xavier?
It all depends. It depends on the individual and the situation. But here's the thing, right? Now is a great time to begin to invest. Now is the time where millionaires are made, by going into the market rather than running from the market.
So let's talk about running from the market, because I think that there's two big emotions that drive investors, and oftentimes when we make investment decisions based off these emotions, sometimes we make the wrong decision. So the one that I think that question, the emotion from where that question was coming from, was fear of losing money, the uncertainty of the market. Should I go to cash? Should I cut my losses now? Right.
And I think the other one that's driving that fear, which goes hand in hand with that, is that R word, recession.
It's scary.
Everyone's hearing that word thrown around about, are we in a recession? Are we going into a recession?
Yeah. So let's take a step back and start with this idea of investing. Why do we invest? So whenever you invest $1, you should have a purpose for that dollar, right? You got a pot of money that's intended for long-term. You got a pot of money that might be intended for more short-term purposes. So whenever you get into the stock market, that's the first question I would ask. Should you go to cash? Like, what's the purpose of that money? Like, if you need the money like tomorrow, well, then maybe you shouldn't have been in the stock market if you don't have any other money to cover that that purpose, if you will. But if you're in the market for a long term, hopping out might not be a good idea. Check this out. So this is from Invesco. Okay, this looks at 20-year annualized returns by asset class from 2022 to 2021. So this is like 20 years worth of returns by different types of assets. So an asset could be like the S&P 500. We're going to call that an asset class, right? So the S&P 500 over 20 years on average was 9.5%. Do you want to guess what the average investor returned over that same 20-year period?
I'm going to say about 5.5%, 6%.
3.6%. The S&P was up 9.5, and that's typically the index that we use to measure the market return. The average investor was only up 3.6%, and it's precisely for the emotion that drove that question. Should I go to cash? I'm scared. I'm going to go to cash, and I'm going to wait for a better time.
So most investors they see the market going down, they're pulling out, and now they're trying to time the market. When do I get back in? And on one of our previous podcasts, we actually talked about trying to time getting back in and missing some of those runs. That was about 3 podcasts ago.
What did we? I mean, here's the problem. This is a conversation with a client yesterday. Is if you go to cash, the context here, okay, is you don't need the money right now. Okay, you still have time. So anytime you ask and listen to this, listeners, this is really important. Any financial decision or any financial answer that you get has to be specific to your context. All right, so that's really important. One thing that bugs me is, and I listen to some of these other financial shows, and when they give blanket advice as being the right advice, and that's rarely the case. But if you've ridden the stock market down, okay, and you sell because you're afraid and you still have more time to recover, the problem is you're locking in all those losses. Yeah, I get it. It's a loss is a loss. You know, your account's down. It was 100,000 and now it's 70,000. But if you sell, you take that asset, that money out of the market, and now you prevent yourself from being able to participate in the recovery.
So what I'm hearing you say, Erik, is we need to revisit our goals. We need to find out what the purpose is of the money and what the time frame is. And if we have time in the markets, rather than panicking and pulling out, I should stay in.
Well, it's like this. Let's say I went surfing. I tried to surf once.
I was going to say, I didn't realize you surf.
I don't. I was in Hawaii, and we're at Waikiki Beach. Beautiful. They got these long rolling waves, but it's a lot of work to surf. But anyway, if we're going to go to the beach and we're going to surf, and you're like, I really want to surf, but I don't want to get in the water. Well, you're never, ever going to catch a wave, okay? You might be a beginner, so you might be afraid of big waves, so you're not going to go surf in the big waves. You're going to go in the smaller waves. And it's the same thing with the stock market. If you want to grow your money in the stock market and you sit on the edge, on the sideline in cash, on the beach, you're never going to grow your money. So maybe your portfolio shouldn't be in big waves. Maybe your portfolio should be in smaller waves. But the point is that if you're going to surf, you got to be in the water.
Right.
And it's making sure you're in the right part of the ocean to catch the waves that are appropriate for your purpose, if that makes sense.
Absolutely. So in that question that I just talked about, should we go into the market with talk of recession and the market's down? Let's address that R word right now, real quick.
Okay.
Let's talk about recession. So here's a number for you guys.
Are we going into a recession?
Right. Are we going into a recession?
Are we going into a recession?
So historically, since 1948, we've had 11 recessions that have occurred. On average, prior to 2007, on average, those recessions have lasted about 11 months. So is that a long time? Maybe, maybe not. Again, it depends on your purpose for those monies. Now, in 2007 to 2009, historically, that was one of the longest recessions. That lasted 18 months. 2020, I think everyone can remember going back to 2020. That was the shortest recession that we had. That lasted 2 months.
It was quick. in all these conversations we're having about the stock market right now, with the stock market being down, and I go back and we look back at 2020, and even now looking back, like, people don't realize the stock market dropped more in 2020 than it has in this downturn. Which when I tell most people that, they're like, no way. I'm like, yeah, this has just lasted a long time. This has just been like a slow grind down,
right? And
we haven't started grinding back up. So it just feels worse. But like 2020 was, I think the S&P was down like 31, 32%. But it was quick.
And people panicked. So, Erik, here's a question for you then. Typically, how long does it take for us to get out of a bear market, for us to recoup some of those losses?
I don't know.
So I did some research on this earlier today.
You set me up for failure. You did that on purpose. You knew I wouldn't know the answer to that. It's messed up, dude.
5 months. Historically, it takes 5 months to rebound and to make up for the losses.
So what's a bear market, Xavier? And how often do we have a bear market, Xavier?
See, how often? I knew that was coming. You set me up for failure there. I know.
So what goes around comes around.
I see that.
Bear market, 20% drop, right? It's a 20% drop in the market. Now, when we say the market, we're typically talking about the S&P 500. There's the NASDAQ that a lot of people have been following. That's the more techy, growthy index. And then the Dow Jones index, which is much bigger companies. The S&P is 500 companies. So a bear market is 20% drop from the top to a bottom, from a peak to a trough. And I think they happen on average every 3.5-ish years, somewhere around there.
So it is a common occurrence for it to happen. And again, it goes back to purpose and time. For those who have the time, stay in the markets without jumping out and panicking.
So that leads to another question that we're getting a lot. Is it a good time to invest, or should I wait longer till things get a little bit better? And kind of all these questions are tied together. Mm-hmm. This one's interesting. It comes back to the issue of timing. Like, first of all, I joke with clients, if I was that good and I knew the perfect time to get into the market, after doing this for 20 years, I'd be retired.
So you mean you don't have a crystal ball?
I don't. Yeah, I'm not that smart.
We'd be rich if we had a crystal ball right now.
Well, maybe we'd be richer than what we are.
Yes,
we'd be richer. So, but market timing is a dangerous proposition. I was watching a TikTok video. For the record, if you're getting your financial advice from TikTok people, probably not the best place. And there's this kid, maybe he was like 18, could have been older than 18. And he's like, I'm going to teach you how to make money in the stock market without having any knowledge of stock. So you buy a stock that's going up, and then as it goes up, then you sell it, and you keep doing that, and you're going to make a lot of money. I'm like, oh, thanks, man. I appreciate that. All the time I spent, getting licenses and my certified financial planner, and it's that easy. But here's what we know. So market timing is there's going to be people who make a lot of money. There's going to be more people who lose a lot of money. So timing the market is very, very difficult. There's trends. As investment advisors, we can look at trends. We can see trends in business cycles in different industries with different companies, and capitalize or hopefully capitalize on some of those trends. But like picking the right time to sell and the right time to buy is difficult. But here's what we do know. So there's a consumer sentiment index. So it basically tracks how consumers are feeling about the stock market. And if you want to take a guess, so low sentiment and high sentiment, what do you think the best time to invest money is?
In between?
No, when sentiment is at its lowest.
Okay.
When people are most scared.
I'm buying when it's at its lowest.
When that thing troughs, when it's at its bottom, there is a 12 months after when it's at its bottom, 24 months after, and we're looking historically. So we're going back historically at this chart and saying, okay, when was it at its trough? Let's look forward 12 months. On average, on the 8 lowest troughs, on average, the market returned 24.9% the following 12 months.
Wow.
If you wait till times get good. So the same thing, the 8 peaks. If you
Correct.
wait till times get good and invested at the peak when everyone was feeling really, really good, your average return was 4.1% 12 months later.
And I have this conversation on a regular basis. You know, that question comes up, when should I invest? Is now a good time to invest? And those conversations are, if you don't invest now, we're low. Go ahead and put money in. You don't have to dump deposits in, but let's come up with a strategy to begin putting money in now, because we don't know when we're going to see that run in the market.
It is counterintuitive, right? Like the best time to buy, if you come to me and you're like, hey, I want to go buy a car. All right. And we know that it's like, I don't know, Labor Day or the end of the year coming up. And we know that's when they do all the specials, for cars. I'm going to say, hey, why don't you wait a couple months, because cars will be at a discount. You'll be like, yeah, that's a great idea. Okay. Now, if you come to me and say, hey, I got some money and I want to buy some stocks, I'm going to say, wait till it's scary as hell. Okay. Wait till the R word is being used. Okay. Wait till everyone is so uncertain and fearful, and then buy stocks. You're gonna be like, dude, you're crazy. I'm gonna hold on to my money till things get better. That's like saying, okay, well then why don't you wait till they're charging a premium for that car and go buy it? You're gonna think I'm crazy. And it's the same thing with the stock market. The problem is the best time to invest is the scariest time. It's counterintuitive. It goes against like that emotion that is elicited because of fear.
Because at the point where everyone's talking about investing in stocks in certain stocks, at that point, it's too late. They're talking about it now because it's made these runs and they're seeing the returns on those stocks. So buy when you're afraid.
Yeah, I had a question the other day. It was something along these lines. It was, I have some cash. I'm going to need it maybe like in 2 years. And this is a younger investor, okay? I might need it in about 2 years. Should I invest it in an S&P 500 index? So an S&P 500 index fund is an investment that tracks the S&P index. So my initial thought was, I got so many more questions to ask. I can't say, yeah, I got so many more questions. Do you have other money out there? What's your risk tolerance? What happens if it doesn't go up? What happens if you lose 20% of your money? Are you going to be okay? And through a series of questions, he came to a conclusion of what he was going to do with that money. But that's the thinking, and I appreciated that thinking. It's the market's down right now. I think it's going to be up. Should I buy now?
And that comes up often, and as you just mentioned, my response to that would have been, it depends. And then going to ask more questions, where is that, do you have cash sitting on the sidelines? If anything were to happen, do you have the money to be able to go in there and use those monies where you don't have to liquidate your investment account? So I think that was a great answer.
That's what I told him. I said, okay, so here's 2 scenarios. Okay. You invest this money, and in 2 years, let's say it's $50,000. Okay. So let's say in 2 years, it's up 20%. So your $50,000 is now what?
After 2 years, let's call it 57.
57,000.
57,000.
57,000. Okay. It's a reasonable scenario. That's 10, 15%-ish, or somewhere around there, I guess. And on the downside, let's say we're down
42, 43.
42 or 43,000. Are you comfortable with those 2 scenarios? He goes, yeah, 42,000. That's not going to stop me from what I needed to do with the money. But the idea of having 57, is nice. I said, okay, well then that's your answer. If 42 or 43 puts you out, then don't do it.
All right.
Risk and reward. There's a potential risk and there's a potential reward there. So I think the takeaway here is there's no right or wrong answer all the time. There's sometimes better or worse answers, but it's always going to depend on your personal situation.
Right. The next question, or one of the next questions that I've been getting over the last couple of weeks is, why are we continuing to see prices on goods? It doesn't matter what the goods are, but why are we seeing our prices increase as fast as they are? And, one of my answers when I had that question is, well, we've got to look at economic growth and or recovery. And what does that mean? So we're coming out of a pandemic within the last, 2 years now, 2.5 years now. And we are now starting to see the economy grow. People are starting to spend money now. And when people are spending money, prices or corporations are increasing their prices. We're going through, the chaos of supply and demand right now. And inflation. So those are three of the things that we've talked about when we're looking at why our price is increasing.
Yeah, go back and listen to, I think it was episode 2 of our show. We did an entire show on inflation when it was just started to become a thing. But yeah, we come out of the pandemic, and this is not necessarily a pandemic problem. It's part of the problem, but for years and years and years and years, we've had historically low interest rates, which means that people can borrow a lot of money. When people have money, as Xavier said, they start spending more money. There's more dollars in the economy chasing the same goods and services, and that tends to drive prices up. But
right.
The pandemic certainly, when the government put a lot of money into the markets.
Right, there was
pockets.
Probably 5-6 months that people weren't spending money. The government then started dumping money into the economy, and when we came out,
people started buying crazy speculative investments. That's a different story.
Yeah.
That's a different story. But yeah, that's why prices are going up. I mean, it's complicated. It's complicated. Oil is a big factor.
Right.
I mean, the price of oil is in everything.
And oil, the price.
Costs,
right. I was going to say the
food
price.
costs are being driven up primarily because of the cost of petroleum, cost of oil.
Right. And you look at transportation of getting these goods around the world. As oil goes up, transportation becomes more expensive, and that's being passed down to the consumers.
But we've seen high inflation. I mean, this is not abnormal. We've seen scenarios like this. You've heard me say this before. History rarely repeats itself, but it often rhymes. Right? We've seen a lot of these themes. Inflation will go up and it'll come back down. Here's why I don't think the outlook is as gloomy as some are making it, because of a couple factors that you already mentioned. Recession or no recession, I don't think it's going to be too dark. I hope I'm not proven wrong, but people still have money. The American consumer still has a healthy balance sheet right now. Now, that might not be your individual case, but as a whole, when you look at the numbers, Americans' wages have gone up. They have a little bit more money. Now, it hasn't kept up with inflation, but generally speaking, wages have gone up. The American people have healthy balance sheets, and companies are still making money. I mean, they're not. This is not a 2008 scenario where companies had a bunch of debt, people had a bunch of debt. It's a totally different situation. And I'm convinced that once there's a solution with oil, inflation is going to start to get tamed, and presumably we'll see some recovery in the stock market.
Right. I mean, we're still traveling. This summer, we're probably, I saw some numbers, we're traveling more than what we have in the past 2.5, 3 years. And we're still buying stuff. We're still out there shopping and spending money.
So here's a question. I think this is the last question. We'll wrap it up with this one. Since the stock market's down, this is a question that comes from that position of uncertainty and fear. The stock market's down, I have debt. Should I just go ahead and get out of the stock market, pay off my debt, since everything's down, so I don't keep losing money, pay off my debt, get rid of my debt, and all that money that I was putting towards my debt, I'll start to put it back into the stock market?
That's a great question. And this is something that you and I were tossing back and forth because it came up a couple days ago. I think the client had his money inside of a qualified plan or a retirement plan, and he wanted to
client's retirement age, and it was retirement money. That's right.
So he wanted to pull the money out one of the biggest problems that could occur is, what's your tax liability? He's still working, and then he's going to pull money out to pay off debt. That is going to increase his income, his annual income. So now we potentially are looking at a tax problem.
It's expensive tax.
That
was part of it. Part of it was we have to deal with those taxes, and we're going to pay a higher tax just to access the money today
to pay off debt.
But a bigger concern for me was, kind of goes back to something we were saying earlier. We're taking that money out of the stock market. We're taking that asset out of the stock market. So if history is a good indication of what's going to happen in the future, the stock market's going to recover eventually. We saw the sentiment index, right? The best time to be invested is when sentiment is lowest. If we're somewhere near that bottom, I don't know if we are or not. I would argue that we are somewhere near that bottom. Maybe we hit the bottom already. Maybe we still have a little bit more to go. But I would argue that we're somewhere near that bottom. Then taking an asset out of the stock market right now that's kind of taken a little bit of a beating. You're removing that opportunity for it to participate in the recovery. That it actually would make more sense. Let it recover. And then go in and take it out.
Right.
If that ultimately is the purpose and ultimately your goal as an investor to pay off your debt with that investment dollar, you're better off waiting 12 months, let it recover, and then doing it.
Erik, I like the way that the thoughtful thinking process through these questions, how that helps clients to really sit down and answer their own questions. So if you guys have questions like this and we haven't answered something for you, go to your financial advisor, have this conversation with that individual, because they're going to help you to answer your questions.
Here's something. I know I said one more question. That was our last question, but let me kind of end with this question here that I'll get often is, why is it worth paying you, or why is it worth paying a financial planner to give you financial advice? What value am I going to get? And I can tell you this right now. Of the 4 or 5 questions that we just discussed, our answers could potentially result in thousands and thousands and thousands of dollars in your account that you otherwise could walk away from because you made a bad decision with money.
Right.
So that is the value of having a financial planner who's standing next to you, helping you make decisions that are consistent. This is key, that are consistent with your purpose, with your goal, and with your values.
Right. A lot of times the advisor's working it through with you, having that conversation. It is a valuable asset to have an advisor by your side.
Yep. I like to call it financial thought partnership. It's the same way if you're a business owner, you would sit down with a board of advisors and bounce ideas off and make a decision. It's the same thing, having a financial planner. So y'all, look, if this was valuable to you, please share it. If you have a question, hit us up online, stuffaboutmoney.com. We appreciate your loyalty for listening. Go out there and do well with your money.